Most people think that you need to own your home in order to write off the home office deduction. That is far from the truth. I have a big portion of my bedroom that I'm using for business purposes right now. Talk to you about why having a home-based business is one of the fastest ways to actually build wealth. And it's not what you think. I'm not saying that you should run out and go start a business because you're going to make a lot of money. The number one expense that we have in this country is taxes. So the average household in America will spend more money on taxes than they will on food, clothing, housing, and transportation combined. Okay, you heard me say that correctly. So the reason why I tell people that they should have some sort of home-based business or business in general is that you have got to figure out a way how to get into the tax system that was created to provide wealth for you, not the system that was created to steal wealth away from you. And that system that was created to provide wealth is the business owner tax system. The system that was created to steal wealth away is the W-2 employee tax system. So what is the easiest way to get into that business owner tax system or the wealth system? And that's to start some sort of home-based business. Now, I don't care what that looks like for you. I don't care if you want to start a blog. I don't care if you want to start a network marketing company. I don't care if you want to start selling products or services or things that you actually personally hand make and actually sell online. What I want you to do is just find some sort of business, something that you're passionate about, something that you can tell people about so that you can force more tax deductions and obviously you can save more of your hard-earned money. Now, the strategies that are involved in that as far as helping you reinvest your profits efficiently. So, there are things that you can buy that may necessarily they're business expenses, but they're also personal expenses. That's a great way. Actually, it's called redirecting your living expenses and turning those into business expenses. It's a great way for you to save money in taxes, but it's also a way for you to get the things that you want and you need, right? So if we're attempting to earn income, and I'm using my vehicle to utilize that for business purposes, then obviously I can write off a percentage of my vehicle. I can write off a percentage of my cell phone, of my internet, of my travel. I can hire my kids, all of these things that I can do because I'm now a home-based business owner. So you don't have to start a structure. You don't have to actually start an LLC. You don't have to start an S Corp or a corporation. None of those things have to go in play. When you're starting a business, you just need to actually attempt to earn an income. And the IRS considers you to be earning an income, attempting to earn an income by spending 3 to 5 days a week for 45 minutes a day on business building activities. Now, what are business building activities? That's literally going in and sending someone an email, sending someone a text message, messaging someone on social media, posting comments and post on social media so that people know that you are truly in the business to make money, right? So if you are attempting to earn income, putting in 3 to 5 days a week, 45 minutes a day is what the IRS considers to be attempting. And the great part about that is the things that you're already currently doing, again, are redirected from living expenses into business expenses. So some of the things that you can legally write off are things like travel, which is a huge deduction. So there's ways to force all of your travel to be tax deductible if you are in fact spending 4 hours and 1 second of your day building a business. So if let's say that I have clients that are in Hawaii and I want to go to Hawaii to visit them to build our business up. So I could plan a trip that on a Thursday I fly to Hawaii. That's considered a travel day, a full travel day. So whatever time I get there, it doesn't really matter what I do afterwards. I can spend the day on the beach if I want to, or I can spend the day with clients. It does not matter. That Friday, then I decide that I need to spend at least 4 hours and 1 second with my client. I have that already scheduled before I go. Then on Saturday, Sunday, if I have plans for Monday in that same location, then I can actually don't have to work that weekend. I can stay there, spend time with my family if I take them with me. What I'm doing as far as my hotel stay, my car rentals, those are all tax deductible, as well as food. 50% of meals can be written off. And then Monday, I have my 4-hour and 1-second meeting or event that I'm going to, and then I could fly home on Tuesday. Now, the only thing that's not tax deductible on this travel trip would be my entertainment. So there's ways to force things to be tax deductible if you are truly attempting to earn income. So now, because of my business, I'm able to fly all over the country. I have clients in every single state. And so if I want to go build a business, then I want to go be in that area, travel in that area, then I can schedule time with my clients beforehand, make that intention to build a business, right? Or connect with them while I'm there. And then as long as I'm spending 4 hours and 1 second of work day on that business, then I can write off the rest of that. And so one of the greatest benefits is being able to write off your travel. The other thing, you can hire your kids. You can pay them to do things that you would have other people do. And so you're not losing that income, right? You're shifting the income off to your kids. You're allowing them to pay for the things that they're spending money on or that you're spending money on for them. Now they can use their money for their education. They could put it into a Roth IRA. You could use it for vacations if you wanted to. Anything that's not a tax deduction. It could be gaming, it could be, sports, all of those things. So that's another huge tax deduction. And with that, hiring your kids, there are deductions such as being able to write off your swimming pool and your exercise facility and a golf course and a tennis court. So all of those things, if they're on your property and you allow your children to utilize them, guess what? Because your children are your employees, that's considered an employee benefit, and that can be 100% tax deductible. Not to mention being able to write off college education. You can pay up to $5,250 a year for their college education, and that also be an employee benefit. So there's lots of ways to get some major deductions from your kids. I take my kids with me to events. I love going to events and learning about how to build our business, how to grow our wealth, and then also teach our clients to do the exact same thing. So the one major benefit for me is to take my children with me to these events so they're learning as well. And then I would typically, because I talked about that 4-hour and 1 second rule, I would typically go a couple days on the front end or a couple days on the back end with my kids and spend time with them. And, it's a great bonding experience because I only typically take one at a time, and they're able to learn the same things that I'm learning. Not to mention their continuing education, because the intention is for them to work for us. And now actually 3 of our kids do work for us full time. And since they've graduated from high school and college, they're learning as they're growing your business and growing the network. So that's obviously a tax deduction as well. Another big deduction is writing off auto expenses. So you can choose to, depending on how much your vehicle's used for business purposes, you can do standard mileage rate, which I consider standard mileage rate is not as big of a benefit typically as actual expenses. Whereas actual expenses, you can not only depreciate the vehicle, you can write off the insurance, the property taxes, the mortgage interest, the repairs and maintenance, the gas, the oil changes, the car washes. All of those things are deductions based upon your business use percentage of that vehicle. So if you're using the vehicle 60% for business, then 60% of all of those expenses would be written off. So that's a huge deduction. And how do you determine the business use percentage? Well, you would take the business mileage and you would divide that by the total mileage of the year, and that would give you the percentage that you would use to write off those vehicle expenses. Or you can take the standard mileage rate, which is 67.5 cents per mile. Whichever one ends up being better for you. I will tell you that if you start with the actual expenses method on one vehicle, you cannot switch back to mileage. So say after you've depreciated it out, you want to switch back to mileage, you cannot do that, but you can switch from mileage to actual expenses. Another really good deduction that I love to talk about is giving back. So charitable contributions, typically 96% of Americans don't get any benefit from charitable contributions. And so one of the ways to be able to add that back is, instead of giving from a net income after expenses level, you can actually give from a gross income level. And if you give from a gross income, let's say I'm going to give 5% of every dollar I make back to a nonprofit to do something, or I'm going to give 2%, or I'm going to give per client. For every client that I bring in, I'm going to do this, right? That becomes a business model and actually becomes a cost of goods sold item, not a charitable contribution. So what I mean by that is that if you create this business model of giving, then you can actually write off 100% of your giving against your business income. So that's a much bigger deduction than maybe getting the benefit from a charitable contribution on an itemized deduction. So if you're excited about giving, figure out a model of giving that you're going to give from a gross income level, whether it's a percentage, whether it's per person, per client that comes in, per product that you sell, and start providing that. And then now you get the benefit from taking advantage of cost of goods sold. That's one of my favorite tax deductions. Another really good tax deduction that most people do not know about is something called the Augusta rule. And the Augusta rule says that you can rent your house out 14 days a year and you don't have to pay taxes on it. And that was created from the Augusta Masters when people would actually, the PGA Tour was coming into town, people would move out of their homes, they would rent out their houses for 2 weeks for those houses to be able to be used for people who were coming in to watch the Masters, because there wasn't enough hotel rooms. And so what they determined and tax law created was that you don't have to pay taxes on your income that you generate from renting your house out up to 14 days a year at all. So that means that you as a business owner can rent your house out to your business and you don't have to pay taxes on it. So if you host events at your home, if you have people come over for presentations, if you do trainings, if you host masterminds, which is one of the things that we are working on, then you actually say you have the going rate in your area. So let's say that it would cost $1,000 a day to rent a facility in your area, either at a hotel or an event center. Well, you can utilize the same $1,000 a day, and that go towards paying you personally from your business, because you need to utilize that property to have a facility for you to go for an event. And so you can do the exact same thing as, if a hotel, you would get a going rate of a hotel or an event center, what they would charge. And then if you're doing that 10, 12 days a year, 14 days a year is the max that you can do that, then that is a substantial tax deduction for you. I get asked a lot of times, what tax structure should my business be? And so I have broken that down to income points that will help you figure out when is it time for you to switch to a different entity. And so most people get started in business, right? Whether it's home-based business or a brick and mortar location, and they never even put a thought to the fact that they need some sort of structure set up. And so they just start their business, and now they're a sole proprietor. So a sole proprietorship means you haven't set up an LLC, you have not done anything really other than said, hey, I'm in business now. So let's say you went and bought a food truck and you set up that food truck and you got no paperwork. Well, now you are a sole proprietor. Then there are partnerships. So those are really sole proprietorships with two people, right? So instead of filing a personal tax return listing it as a Schedule C for your business, you now have to actually have a partnership tax return. And that's regardless if you have an LLC or not. So even if you haven't set up any structure, if you and someone else owns a business together, then you are required to file a partnership return. Both of those, sole proprietorships and partnerships, don't really save you any money as far as taxes go. They both flow to your personal tax return. So one is listed as a Schedule C, one is actually a K1 that flows to your personal tax return. But both of them require you to not only pay federal and state taxes if you live in a state that has state taxes, but you also have to pay self-employment taxes. Self-employment taxes are 15.3% of net income from a business. So if you make $50,000 a year in net income from your business, you have to pay roughly $7,600 a year in self-employment taxes. Now, there's a way to bypass those self-employment taxes. So let's talk about that. First and foremost, once you get started, I tell people, especially if you start a business from scratch or a brick and mortar business, you need to get an LLC regardless. That's called a limited liability company. And what that does is just essentially exactly what the name says. It limits your liability if you are utilizing that business as its own separate entity. So I'm not saying you go get your personal bank account and you start using that for business purposes. You set up an LLC, you're commingling funds. That's not really utilizing it as a separate entity. But if you go get a business bank account, you have an LLC, a limited liability company, and you're not spending money personally out of the business account. Now, granted, you can move money from your business to your personal at any point in time, but you're not spending money out of your business account to your personal. So if you are doing that, then you're limiting your liability, but it doesn't really change anything on your taxes until you decide to treat your LLC as an S Corp. See, the one great benefit of having an LLC, and there's obviously several, but the tax benefit is that you can either treat your LLC as a Schedule C, which is a sole proprietorship. You can treat it as a partnership if there's two of you that own the company, or you have the ability to treat the LLC as an S corporation for tax purposes. Now, what does an S corp do? An S corp allows you to bypass a huge majority of self-employment taxes, and the self-employment taxes are 15.3% of net income. So that same scenario that I explained, if you make $50,000 a year, 15.3% of that is roughly $7,600. If you had a Schedule C, a sole proprietorship, LLC, or partnership, all of those things are treated exactly the same, then you would have to pay that $7,600. Now, if you took that LLC and you said, hey, I want to treat this as an S corporation for tax purposes, that's paperwork that we have to file with the IRS, and you're still an LLC with the Secretary of State, from there, we can now bypass 80% of your self-employment taxes. So it's a huge deal. So instead of making $50,000, having to pay $7,600 in self-employment taxes, you're now paying about $1,500 in self-employment taxes. Now, granted, there's paperwork that has to be done. You have to process payroll for yourself, and we can help you do that. And you also have to have a corporate and a personal tax return. And obviously, we do both of those as well. Now, when do you want to have an LLC? So an LLC is, I would suggest, if you start a business from scratch, if you have a brick and mortar business, definitely, or if you are making more than $1,000 a month. And that $1,000 a month should be in gross income. So meaning before expenses. So when you start making $1,000 a month before expenses, you're going to want to have an LLC in place, okay? Now, when do you treat that LLC as an S corp? So my suggestion is that once you get to a point where you're making $1,000 a month or more, that's when I suggest you take the LLC and you treat that as an S corporation. Now, the really great benefit of having an LLC. So you may say, well, I had an LLC, but I never treated it as an S corporation. Now, we have the ability to go back and treat your LLC as an S corp election to get you back the money that you overpaid, as long as it has not been more than 3 years and 75 days from today. So if you didn't do it correctly to start off with, or your accountant gave you bad advice, we can actually help you go back and get some of that money that you overpaid. The clock starts ticking when you have the LLC, which is why I say once you get to a point where you're making $1,000 a month gross income, go ahead and get the LLC in place. Nothing really changes until we want to treat that LLC as an S corp election for tax purposes. So we file the paperwork with the IRS. we get that S corp election, we file a corporate tax return, and now you're saving 80% of the self-employment taxes. Most people think that you need to own your home in order to write off the home office deduction. That is far from the truth. And I will tell you this, one of the biggest things that I have people tell me all the time is that their accountant has told them that they're more likely to be audited if they claim business use of home. That's not what I see. Okay, we prepare about 2,500 tax returns a year. I've never had a client audited for business use of home, so that's just not true. That is a true myth, and I want you to understand that that is just a way for you to have to pay more money in taxes, right? Okay, so what can you write off for having a home-based business? One, whether you rent or whether you own, it does not matter. The rental income or the rental expense could be written off, and the mortgage interest and depreciation could be taken. So if you are utilizing your house, if you have a space that's for either for an office or maybe you're storing, inventory in a garage, something like that, as long as it's used exclusively for business purposes, and it could be a portion of a room. So I'm actually in my home office right now. I do have a brick and mortar office that all of my employees work at, but since I've had my little girl, I've decided to work from home and the staff works at the office. So I have a big portion of my bedroom that I'm using for business purposes right now. So it's about 50% of my bedroom. So I have a big room, and so I can map out the square footage of that room, and based upon the square footage of the house, and that would be the business use percentage. Now, one of the great things is that you can back out closets and hallways. So I have some really long hallways and big closets, so those can actually be backed out of the square footage. So once you have that number, you can actually take advantage of that business use percentage multiplied by, you write off the mortgage interest, the property taxes, the insurance, the interest on the house, or excuse me, I've already said interest on the house. You can write off the utilities. You can do repairs and maintenance. And then anything that you are specifically using for your home office, like if I bought a new laptop or new furniture, I put a new flooring, or I put a new paint job, or any of those would be 100% tax deductible. And the only difference if you're renting is that instead of doing mortgage interest and probably having property taxes, then you're going to write off the rent. Okay, so there's no difference between you renting the house or owning the house to get that tax advantage. And one of the great things about having not only a home office, but also a co-working space or an office that I do, a brick and mortar location, you actually get not only the benefit of writing off the house as far as business use percentage, but you also have considered what's called commuting miles. So if I get in my car and I drive anywhere to build my business, whether that's to my office or to see a client or, to fly to the airport to go to an event, those are all tax deductible for me, as opposed to if I just had a brick and mortar location at my office, right? Then that would be considered commuting miles, and the mileage from my house to that office would not be considered tax deductible. So it's a huge benefit to have a home office. Also, if you do have a co-working space, that's great. Some of us can't get around it. Obviously don't want, my 12 employees working from my house or inside my house. So they have their own space, and then I have my own space, and then obviously we get the tax benefits from there.